We're talking about Nigeria's debt, foreign debt side now, $2.5 billion US. And we know that with what's going on the global front, talking about the US Fed raising rates on one hand, and of course fund managers looking at how they would be repricing assets, especially in emerging frontier markets like Nigeria. What is your submission now in terms of how that is going to pan out, especially for the federal government?
For the federal government, the implication of Fed normalization of its monetary policy is higher interest rates in the global economy, which means that less funds from the global economy will find their way into Nigeria because the U.S. Treasury notes and Treasury securities offer more prospect. So we clearly see a flight to capital. That's from the asset allocation perspective for fund managers, for country sovereign borrowing. Of course, everything is always tied to the U.S. Fed action because, of course, New York is the biggest financial market in the global economy. The amount of dollar passing through New York can make you faint or collapse, if you see the quantum.
That's one way to put it.
So implication is that as the Fed normalizes its interest rate policy, as the federal government begins to borrow to fund the 2018 passed and signed budget, we will see a tendency towards increased borrowing rate for the federal government. You must understand again that if you look at the deficit for the 2018 budget, deficit will be about 2 trillion, will be financed 1.6 billion of that, 1.6 trillion of that to be financed from external borrowing. The balance will be financed from sale of government assets. So if government says that almost, the whole of its its deficit to be financed from the external environment, implication is that they will be approaching the debt market. You just the international debt market, you just mentioned about $2.5 billion that they intend to borrow. So as Fed continues to normalize its policy rate, the interest rate in the global economy will increase, and the borrowing rate of the federal government will increase, which further exposes Nigeria. There was always this argument that Nigeria has fiscal space. Nigeria can borrow more because our critical limit is 40% of GDP. But about
technically, 12%. That is still true. Technically, for now, that is still true.
But the interest expense to revenue is very enormous, very huge, about 79%, latest figure, which shows that substantial amount of our income is used to service debt. So that is the problem. That's the limiting factor that we have in terms of advancing.
I'm curious to know, we had a good outing the last Eurobond issue. I'm just thinking, what kind of rates, coupon rates, could we be looking at this time for the government, as, premiums will obviously be higher?
Plus 75 basis points, 100 basis points, from the last time we had. We've been raising money between 5 to 7%.
Is that significant? Is that,
Yeah, it is significant when you look at quantum, in terms of quantum of the exchange rate risk that we're exposed to, anything that happens with the price of crude oil international market. The argument is that, okay, we may say we are insulated from exchange rate risk in the payment period because of the high price of crude oil and all of that, but the price of crude oil is volatile. Whether I like it or not, crude oil is still the most significant, crude oil receipt, in terms of income receipts, is the most significant source of inflow into the Nigerian economy. 76% of Nigeria export income is from crude oil sales, which shows that we're still very, 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 very tight, the volatility in the crude oil market. So we may say that 75 basis point, 100 basis point is not significant. Well, it is significant when you look at it from the perspective of the interest expense revenue. It's quite a lot.
Okay, so you've painted a rather grim future for Nigeria's borrowing future. And I know I said future twice. But now what I want to know is, Patience Oniha says that she's going to look for the $2.8 billion of foreign borrowing that she plans to do for this year, this Eurobond, some people are calling it. We're not quite sure if it's a Eurobond or not. But is this the time that we might start to look to the IMF for maybe better rates? I know that Kemi Adeosun says that the IMF is the lender of last resort and Nigeria simply isn't in that position. But then with how you see things, do you think you would consider the IMF if you were in their shoes?
I will never consider the IMF.
We're not there yet.
Because considering the IMF,
I can imagine what the finance minister say right
IMF, use a very technical word, which is a word that shows that you are in distress, you're seriously in problem, lender of last resort, just like the central bank. Any bank that approaches the central bank as a lender of last resort, the central bank will look at you critically and you'll be put on alert that, okay, there's something fundamentally wrong with that economy. In the case of IMF, there's something fundamentally wrong with that bank in the case of the central bank. But let me correct that argument about a green picture for the Nigerian economy in terms of the borrowing. Debt in itself is not bad. Debt in itself is significant. It's good. Debt in itself, if it's tied to infrastructure projects, if it's tied to capital expenditure to help to boost, economic activities and help to, increase economic activities that will generate such activities that could be exported in the case of exports, so that we can achieve more income and diversify the income. So that is not bad. You know, Nigeria is in a robust position. It's not very bad for us because of the outlook for crude oil. But overall, anything that, the volatility of crude oil is very, very unpredictable, and so we need to watch that space continuously.
We'll keep watching.
Thank you so much, Babajide.
Thank you so much for your time. We've been speaking to Babajide Sholanke. He's an analyst at FSDH Merchant Bank.